What's going on, investors? AK from Fallible here. And today, just for you, I got the 3 stocks our team is looking at for July. It's true, I just made the June video a week ago. So you're probably wondering why I'm making a July video now. Well, that's because I like views. And on YouTube, we all play this dirty little game where the smaller channels try to publish similar videos to the bigger channels at the same time, just so we could get a little bit of views. Because views are so important, and views make the world turn. And then everybody comments on each other's videos like, oh bro, great stock picks. Oh yeah, I really like what you're doing there. Oh yeah, I'm looking at that stock too. Cool. And the point of that is so that people on the big channel can see those comments and then come over to your small channel, and then you get more views. Because views, right? Now, surprisingly, not many other YouTube finance guys like to comment on my videos. Now, I assume that's because I'm a maverick and I play by my own rules, which is not that true because I'm a slave to YouTube's algorithm just like everybody else. So what's more likely is that they never heard of me, which is kind of sad, but yeah. Whatever, who cares, right? It's not all about the views. It's all about the views. But you guys don't care about all this YouTube politicking. You care about the research. And fortunately, my team has done a lot of research, so much that I'm not able to share it all with you on one single video. So this works out because this July 3 stocks video is gonna be basically a continuation from the June one. So in the June video, which if you haven't seen, I'll link to above, we talked all about the FAANG stocks, specifically Google, Facebook, and Amazon, and why in this type of market, those momentum names are exactly where you wanna be. And remember, I was talking about the herding effect with the cantaloupe, which if you picked up on it, you know, cantaloupe are actually a fruit. And what I should have said was an antelope, but so like cantaloupe and antelope kind of sound alike, so it was a joke because cantaloupes can't herd, but you know, I'm sure it sounds really funny because, you know, jokes sound really funny when you have to explain them. But anyway, a lot of investors have been avoiding the FAANG stocks because they think the trend is old and overcrowded, and that these names are overvalued because the trend has been running for so long. It can't keep running forever, right? But in reality, a lot of these investors are not taking into account the massive networking effects these companies have. So their networks, in addition to their reinvestment and compounding growth, actually make them seem undervalued compared to their potential. So in this case with FAANG, investing in the popular opinion is actually the way to go. Now there is another area of the market that is in a similar situation to the FAANGs, and that is the semiconductors, which are microchips. And the 3 stocks that we're looking at in July are all in the semiconductor space. So as you can see in this chart, semis have some strong momentum going behind them, just like the FAANGs. Just like tech, semiconductors have more than tripled the market's return year to date. These companies have really solid fundamentals backing them, and yet the market is still misvaluing them. And the reason for that goes back to the fact that these semiconductors generally have a short capital cycle. And for the last 2 years, investors have been worried that the semis are late in that cycle. So at this point, they're not investing because they're just waiting for the cycle to turn. And when that cycle does turn, chip demand falls while the capacity of these companies to produce those chips keeps increasing. And that mismatch between supply and demand leads to lower pricing and crushed margins. So that's what we've seen happen this far into the cycle and every cycle in the past. But actual data is telling us this cycle is not close to being over. Last year, semiconductors recorded their largest year-over-year sales growth in 14 years. In this quarter, the IT sector had the second highest earnings growth rate of the entire S&P. And within that sector, semis were second on the list for the most growth. They saw an increase in EPS of 54.5%. And they also saw a super strong top line growth of 28.2%. So the bears could be right, but they could just be early and that the cycle turn is coming, or they could be anchoring too much to past cycles. And in this cycle, something is different. And I know saying it's different this time is one of the most dangerous phrases in investing, but hear me out here. Now, every industry, regardless of what it is affected by large secular cycles. And secular cycles are decades-long periods that are affected by a structural shift in demand. So a structural shift is when there's like a massive technological change, like smartphones or something. Or it could even be a demographic change, like we explained in that S-curve video, which we related to India, which if you haven't seen that video, I'll link to it above so you can watch. So in the case of semiconductors, it's likely that they've entered into a new secular trend. And this trend is being caused by the increasing amount of computing power that we all need. And I'm talking about all the different stuff that we use these chips for now, like artificial intelligence, machine learning, the Internet of Things, cyborg brothels, augmented reality, virtual reality, big data, medium data, small data, autonomous driving, semi-autonomous driving, bird scooters, virtual assistants, T-1000s that could time travel. All these things have changed the structural demand for microchips. The investment bank UBS had a good piece explaining this. They're saying that from the 70s to 2000, the global spend in semiconductors was growing in the low single digits. But because of things like deep learning and AI, spending will grow at an unprecedented 12% going into 2021. So the current semiconductor cycle that has been unusually strong and long strong and long, still has about 3 to 4 years left to go. There will continue to be memory shortages and prices will keep rising for this stuff. And to meet that demand, capacity will keep expanding, but the demand will keep growing too, so it's okay. There's basically a reflexive cycle that gets created when it comes to big data, because for a lot of these companies' purposes, more data means better results. So they want to collect more and more and more data and analyze it more and more and more. So to collect more data, you need more sensors and chips, which means more semiconductors, right? And then to analyze that data once you collect it, again, you need more computing power, which is again more semiconductors. And the more computer power you get, the more data you want to analyze, which again, you need more chips to collect, which then you need more chips to analyze, and back and forth, and then you see the cycle. And we know how lucrative it is investing in reflexive cycles, because we talked about it in a previous video, which again, if you haven't seen, link to it above. And actually you can see that big time investors like Stanley Druckenmiller and David Tepper, they're both taking advantage of this trend. Semi stocks were their largest new buys last quarter and are amongst their largest positions. Druckenmiller's holdings are on the left here and Tepper's on the right. And you can see on Druck's side, he's really into tech, Chinese stocks, and semis, which are all things we've been talking about at Fallible. So clearly Druck has been watching. And I know that because he tried to friend me on Facebook recently. And of course I'm not gonna accept because I like to play hard to get. But hey Druck, because I know you're watching, I appreciate it, man. That's real nice of you. And I might accept your friend request sometime, but you know, I'm pretty busy, so. The way we're looking to play this trend is with a basket of semiconductor stocks that all have strong fundamentals and good looking charts. So our basket includes Micron, Intel, and Advanced Micro Devices. That's MU, INTC, and AMD. Now in the macro ops portfolio, we already have AMD at a cost basis of $14.84. Our risk point is at $11.50. And for MU, we have January 2019 calls struck at $70. And you know I already talked about Micron in more detail in our April video, which again, if you haven't seen, I'll link to it right here. And right now you're probably looking at the big drop in these stocks and wondering why I'm even talking about them. But really, if we're seeing some true market weakness here, then this is a good opportunity to either enter or add to your position in these names. And I'll definitely do some broader market analysis on this potential correction we're seeing in a future video, because this dip might be a great buying opportunity. So if you want to see that video, make sure you subscribe and hit that bell so you get a notification when it's released. And of course, with all these stocks I'm talking about, do your own research first and stick to your own trading plan. I'm not your investment advisor. I'm just trying to give you a starting point for these ideas. But make sure you subscribe to this channel if you're interested in more videos, everything market related. So subscribe and I'll see you in the next video. Stay fallible out there. Bye.